Ladies and gentlemen, people of the internet, welcome to yet another episode of an ongoing weekly series called Crypto Over Coffee. Every Friday, I pick out interesting news, current events, and announcements in the cryptocurrency and technology world, and then I break them down for you over a cup of delicious coffee. Today, we're talking about Coinbase's bold Bitcoin predictions, anonymous Ethereum transactions, Andrew Yang, Chainlink's latest partnerships, and a whole bunch more. Oh, and by the way, in today's episode, as well as episodes in the future, there will be some awesome giveaways of cool products, apparel, and cryptocurrency. So make sure that you hit that subscribe button and that you stop by every single Friday so you don't miss out. Today, I'm giving away a Trezor Model T hardware wallet to one lucky winner, and all you have to do to win is A, subscribe to the channel, B, leave me a comment below about why hardware wallets are essential, and C, stop by on next week's episode to find out who won. Boom. Good luck. As always, though, let's start the meat and potatoes of this episode with questions from the community on YouTube and Twitter. So I'll jump on the good old iPad now and pick some to answer. And remember, if you want a question of yours answered, make sure that you leave them in the comments down below or tweet me at Hashoshi4 on Twitter. Dan Hannum asks, best crypto tax software ? Great question. My top three would be CoinTracker, ZenLedger, and Node40. Not in any particular order. I think all three of those are really cool and work really well. Thank you for the question. The next question on here is from Joseph Green. All I want to know is, will Ethereum 2.0 take too long? Thanks and have a good one. You too, have a great one. Ethereum 2.0, in my opinion, hasn't yet reached the point where it's taking too long, and it's not at the point where it will take too long. I think even if they launch all the features by the end of 2021, they're still going to be in a good position. I don't think that any projects out there have solved all the problems that Ethereum 2.0 is trying to solve. So we're not at the point where we have winners in the crypto space. I think there's so much that still has to be done to bring this stuff to mainstream, and everyone's going to have a fair shot at doing so. Ethereum does have the advantage though, because they have so many developers already that are working on all this stuff. So there's that. Thanks for the question. How different is Tezos from Ethereum? Love the coffee vids. Thanks. I love these videos as well. And this question is from Script Skynet. Cool name and also cool photo. Now, to answer your question, once you get past the initial definition of both platforms, which is that they're both smart contract enabled blockchain networks that are designed to be platforms on which decentralized applications can be built, these are really different protocols underneath the hood. First of all, Tezos is a complete 180-degree pivot from Ethereum's traditional off-chain governance. Most blockchains built around the time of Ethereum use hard forks for major protocol changes that are not backwards compatible. Tezos is really trying to avoid this altogether with on-chain governance, where a form of democratized management deals with changes to protocol. So there's voting that happens. It's almost like a mini democracy, all on-chain. Beyond that, Ethereum's proof of stake is very much a traditional proof of stake network, where the more stake you put up, the more chance you have of making a block. Whereas Tezos's liquid proof of stake, which is an interesting name, is kind of a blend of delegated proof of stake and standard proof of stake, where you can either stake directly or you can delegate to others without giving up ownership of your tokens. And finally, Ethereum uses primarily an imperative programming language, Solidity, for smart contracts, where Tezos is all in on a functional language called Michelson, which is based on the OCaml programming language, which is totally functional, totally different from Solidity. So there are a lot of differences and way too many to talk about in this video, but that is a fantastic question, and it might be a full video on its own. Next question. Is there any way the transition to ETH 2.0 proof of stake could go so badly through some error or bad foresight that ETH could go to zero? This question is from Joe View Comedy. He also says, keep up the great work and making people think you are Canadian. I am actually not Canadian, despite this sign. I actually got it thrifting in my girlfriend's hometown, which is Toronto. In terms of ETH 2.0 proof of stake going badly, I think that considering how long this has taken and how many engineers they have working on this, at least 100 core protocol engineers plus probably another several hundred non-protocol level people that are helping support the development, I have a feeling that this is going to be built well. I have a feeling that this is going to be effectively done on behalf of the Ethereum Foundation. If for some reason the Ethereum 2.0 transition goes badly, it could destroy the token value of Ether, but I don't even know if that would be the case, because I think they could probably wind it back and just stick with the proof of work chain. Then again, people would probably be very disappointed and lose their faith in Ethereum as a community and as a blockchain network. So yes, it's possible. Do I think it's likely? No. And the last question of the day from Emma Gator Hash: are you staking on Cardano's incentivized test net? I am not. It is not because I don't want to, it's because I do not have time to set it up. I really do want to create a video of me learning how to set it up and subsequently teaching you how to. So hopefully I can do that sometime in the near future, but I will have Rick McCracken from the Cardano Effect podcast and YouTube content creator on the channel to talk about his awesome incentivized testnet work. So that about covers it for the questions today. Now, the first topic I wanted to touch on is a cool project on the Ethereum blockchain called the Aztec Protocol. Aztec Protocol mastermind Thomas Walton Pocock and his team are pushing a new era of private, efficient transactions to Ethereum using their ZK Snark zero-knowledge proof-based protocol. Now, I have a video talking about all sorts of stuff about zero-knowledge proofs, what they are, how they work, etc. So you can pause here and watch that really quickly if you want, using the link above. I will be here waiting for you. ZK Snark is short for Zero Knowledge Succinct Non-Interactive Agreement of Knowledge. And you can probably tell now why it's abbreviated so simply. In a super generalized form, the Aztec protocol uses this zero knowledge scheme to allow one user to prove to another that he or she has enough tokens to cover a transaction, that they own a given private key, or etc., without ever exposing the raw data behind that. This ZK Snarks technology is already being enabled on the Ethereum chain with the recent Istanbul hard fork that introduced scalability improvements based on this technology. Right now, the smart contract using Aztec on Ethereum is for the private version of the DAI stablecoin, ZK DAI. But the same technology could be used to create more private versions of popular ERC20 tokens, or even natively on the Ethereum blockchain protocol to make private transactions native. I'm really excited to see where this implementation goes, and my fingers are crossed that we get to play with it some more in the ERC20 world. Now, with all the craziness of the 2020 election cycle continuing to take its toll on the hearts and minds of everyone in the country and people outside of it as well, it's hard sometimes to find silver linings in all the antics that ensue. For those of us in the cryptocurrency world, and even the broader world of innovative technology fans, we lost our most technology-focused candidate this past week in Andrew Yang. Throughout his bid for the presidential nomination, Andrew Yang spoke of the risk of automation to the workforce, the power of technologies like cryptocurrency and blockchain, as well as a plethora of other tech-oriented topics that are far too often glossed over completely by other candidates. While Andrew Yang's political campaign in this race is over, I think there are positives that can be taken from this process. First of all, Yang brought national attention to cryptocurrency in a positive light. And if you juxtapose that against the standard rhetoric that crypto is only used for criminal exercises, I think the renewed focus on the technology as a tool for positive change is a very good thing. Beyond that, I believe Yang's race has also gotten people thinking about technology and its relationship to our daily lives a little bit more closely. Maybe we'll see Yang in a state race sometime soon where he can be an advocate for cryptocurrency and other innovative tech in the political sphere, but who knows? I'm curious. What are your thoughts about Andrew Yang as a candidate? And even if you're not from the USA, comment down below and let me know, because I'm curious what the sentiment is towards his campaign and the stuff that he talked about. In other news, the retail crypto investing app Circle Invest was just sold to a company called Voyager, who already offer trading services in the crypto space. This means that the 40,000 users or more that Circle Invest had will be migrated over to Voyager by the end of March, as Circle, the old company, shifts completely towards a focus on stablecoins. The Voyager app is a relatively new crypto app, but it's been around for a little while, and they're looking to push adoption with commission-free trading, interest-earning products, and they have over 20 cryptocurrencies to choose from on the app today with fiat to crypto transactions and withdrawals. I tested it out and it's actually a pretty solid app with a nice UI, and fees are taken on the spread, much like you'd see on something like Uphold. Of course, this is a US only product right now, but it is expanding abroad as we speak. I would also say that it does require KYC, as with any fiat to crypto ramp. That's nothing surprising. I'll link it up down below if you want to check it out, but all in all, I think the Voyager application will be a much better home for crypto investors than Circle Invest was. It ended up not being so great. The good news is Voyager will be integrating the best part of Circle Invest platform, and the thing that I liked the most, which was the collections section, which allowed users to buy diversified mixes of cryptocurrencies all in one single click. You could buy like buckets of crypto. This is great for beginners trying to test the waters, and honestly, I think it was a fantastic feature. Now, speaking of exchanges, let's talk about Coinbase and their bold Bitcoin blog post. On February 7th, Coinbase posted a blog post and an accompanying slew of tweets to promote that blog post, and the entire premise of the write-up was that Bitcoin is increasingly living up to its identity as digital gold. In other words, because Bitcoin is a deflationary asset with a fixed supply and an increasingly high cost of acquisition through mining, it's very much akin to physical gold in terms of its value as a store of value. Coinbase went on to postulate that the upcoming halving event, which is going on in May 2020, that will see the total Bitcoin reward for mining a new block go from 12.5 to 6.25 Bitcoin, further supports this definition of Bitcoin as a store of value that's similar to gold. Now, if you really break down the key facts about Bitcoin, you can see that it was designed to be like gold, even down to the terminology. Gold has value because it's scarce and because people have demand for it as a result. This scarcity really comes from the total finite supply of gold on Earth. Bitcoin, on the other hand, has a digitally enforced protocol that creates scarcity. 21 million Bitcoins total will ever exist based on this protocol. Gold initially became so valuable, though, not only due to its scarcity, but due to the overall cost and difficulty of obtaining it, which is done through mining. Again, you may see the parallel with Bitcoin, where mining is the costly and difficult process of fulfilling proof of work and consensus to earn Bitcoin rewards. Mining is even called the same thing in both cases, and that is no coincidence. Some say that gold has utility, and that's what gives it value today, which is actually true. Gold is an essential material in many consumer electronics, and that's great. However, Bitcoin has some key benefits over gold. One of them being the ease of transfer over a blockchain network, the other being the cost of storage. It's far lower. And finally, there's no physical way to increase the supply of Bitcoin. It's digitally programmed into the protocol itself. We already know that there are planetary bodies and asteroids that are rich in gold. When technology improves enough to make mining that gold effective in terms of cost, our supply of gold on Earth could skyrocket. If demand does not increase continuously with that new supply, gold's value could very well plummet. Of course, demand for Bitcoin must also stay stable or increase over time to get the valuation that many people claim we'll have online. But ultimately, I think that Bitcoin has a far better controlled supply than gold that very well could have an increased supply in the future. And down below in the comments section, tell me if you think Bitcoin is a better investment than gold and why you think so or why you don't think so. Moving on, a project that I really like called Torus has been running a beta of their decentralized application login service for a little while now. They just recently moved out of beta and have a nice list of partners at launch. Think names like the Ethereum Name Service, Binance, Etherscan, Ontology, Scale, and more. The concept behind the product is that you can use existing services logins like Gmail, Reddit, and etc. to create a wallet account with Torus that can be used to send and receive crypto, authenticate with dApps from your own browser, and a whole bunch more. This is all designed to make interaction with Web 3.0 applications like dApps faster, less cumbersome, and more accessible to a broad range of users who really can't keep their keys safe. This happens all the time. Of course, this does mean that you technically do not hold your own private key, which is bad in terms of keeping large amounts of crypto assets safe for long-term storage. But for dApp usage, this is a sacrifice you make in control for the benefit in convenience. Instead of making Torus a single point of failure, though, they decided to take the keys created for users through this login service and shard them or break them up into little pieces and distribute those pieces amongst the aforementioned partners that are all nodes in the Torus network. When you want to authenticate for a dApp, for example, you would use your Gmail login with the standard 2FA, which you should be using, and then the Torus client will retrieve your key shards from the variety of Torus network nodes or partners, recombines your key, uses it to sign your dApp transaction, and you're good to go. So this is really cool tech, and I'm really interested to integrate it into one of my own dApps to see how it works. I think it's a lot easier on users to be able to log in the same way that they normally do for other services and not have to worry about keys. When you're holding crypto long term, it's essential. Your keys need to be in a hardware wallet and they need to be owned by you. But for something like this, for dApps, this is a great solution. Speaking of cool tech though, Chainlink is now being used by crypto Visa card service Swipe as a decentralized price data source for their US dollar to Ether trading pair and their native SXP, that's really hard to say, token price against US dollars as well. This is yet another example of how Chainlink's decentralized Oracle network is being used for real projects already. I see this all the time on exchanges. If you go to one and you see one price, then you'll go to another one and you'll see a completely other price. You're completely at the mercy of their pricing sources in terms of data or their algorithms to calculate it. With Chainlink, the aggregation of the pricing information from a variety of sources in a decentralized way makes the price you're seeing more trustworthy and more fairly sourced. If you think about it, you're not getting data from one source that could be tampered with, and you're not having to trust maybe one or two or an algorithm that you can't see. I think you're going to see an increasing number of crypto exchanges and payment providers using Chainlink for pricing of their assets. They really should be, in my opinion. For Swipe specifically, their product desperately needed Chainlink and something like this because of the way that they reconcile transactions. When you want to swipe your Visa card and pay with Ether, for example, Swipe needs to exchange your Ether for fiat on demand, like nearly instantaneously, to fund your USD transaction to the vendor you're trying to pay. If the pricing information is wrong or if it's manipulated, Swipe could lose money on the trade and so could you. This means that a single point of failure for their solution is that pricing API. Whoever they're relying on for data or whatever algorithm they're relying on needs to work perfectly, and Chainlink really does fill this need. Overall, I think Chainlink's a perfect fit for this use case, and I'm really excited to see more exchanges using this type of technology. Now, over in the realm of regulation, everyone's favorite topic, Secretary Mnuchin at the Financial Crimes Enforcement Network, or FinCEN, revealed that his department and other regulatory agencies will be providing or producing significant new requirements for cryptocurrencies in the near future. There was no actual specific detail about what these requirements are, but I have a few predictions myself, and I wanted to share those with you now. We all know that there are regulators that are chomping at the bit to ensure cryptocurrencies are not used for criminal enterprise, nor as a safe harbor for tax evaders. And honestly, this makes perfect sense. I'm all for it. We don't need that extra layer of rhetoric that people can sprinkle on and write off crypto as a whole. We can get the criminals out. This is obvious though. In my mind, we'll be seeing formal guidance on cryptocurrency exchanges, and things like the travel rule are going to be a focus. In an instance where a financial instrument is being transferred from one institution to another, the sending institution must provide certain identifying information about the user and the transaction to the receiving institution. Basically, information has to travel from the origin over to the receiving institution so stuff doesn't get lost. This is designed to prevent crimes such as money laundering and the like. So if you perform KYC at Coinbase and then you send crypto to another exchange, technically, according to the travel rule, if this were a bank, they would have to send some information about you to that receiving exchange. I also think we're going to see formal standards for KYC on all crypto platforms that interact with US entities especially. Again, this is also self-explanatory. Most exchanges that offer fiat pairs, they have KYC around the world, not just in the US. And we're going to hopefully see some clarity at least on what's required and how those things are reported and how that data is kept. That's what I really want to know. We may even see mandatory reporting requirements for exchanges that serve US customers to prevent money laundering and other financial crimes. I mean, these are all guesses, complete guesses on my part, but we'll of course see what happens likely this year. And hopefully, as I've said in several of these videos that touch on regulation, we need clarity. It's not a matter of no regulation is the answer, because in a lot of ways, there are good regulations that should be there to protect people. In a lot of ways, think about it this way. For agencies, not even agencies, for entities of all kinds, exchanges, interest earning products, etc., if they collect your information for KYC, you want to make sure there are standards for how that information is protected from a security standpoint. You don't want to, yeah, well, you need to do KYC, but there's no standards by which you need to store all that sensitive data, right? Think about things like the Binance hack for KYC, right? It was a very free process for them to do it however they wanted, and they fixed it, but only after a breach showed up online with a ton of people's IDs and photos and such. So I think in some cases, standards are a really important thing, and hopefully these regulations will be non-restrictive, but rather giving clarity for everyone so that we can follow very simple rules. As always, folks, I will link up a couple other cool videos here, and I'm very appreciative of your support and your time. So until next week, cheers.